This is economic news on the second day of August 2013 as we roll along. We'll start with the U.S. economy on this program as opposed to the other program. We tend to spend at least an equal amount of time, if not a bit more than that, on the international economy from macro perspective. Here we'll start with the U.S. economy and what has basically occurred in recent days here, and we'll go to what the Fed plans to do, at least in the short term. So we'll start out with the job numbers here that have come in. We need to remember the U.S. economy is kind of a mismatched economy. A lot of pinned-up growth, a lot of demand problems all at the same time. It seems a bit strange, but nonetheless, this is from the Reuters service. Factory activity jumped to a 2-year high in July. The first time applicants for jobless benefits hit a 5.5-year low last week. So these are some things happening, but again, less redundancies have been happening. It's been a trend the last, we'll say, few weeks. We've seen that happening, and basically what has happened is most of the redundancies during the Depression era came, and then you had restructuring redundancies or layoffs happening, and you still have some of that, but a bulk of that happened in 2011 and 2012. So here we are today, sort of a mixture of things here. The future growth outlook remains on a high positive trajectory, keeping the September tapering timeline firmly intact despite the Fed's nod to lower, and we'll get to that, target inflation. That's from Granderly Goldberg, an economist at TD Securities in New York. The Institute for Supply Management said on Thursday its index of factory activity rose to 55.4 last month from 50.9 in June. So new orders and production there, a reading above 50 in that sector. Is expansion, which hit a soft spot in the spring. But remember, the spring in the U.S. in particular was a extension of the winter season. It was a colder than normal spring, so a lot of the types of activities that you'd normally see, specifically in the Northeast sector and Midwest sectors, but did not occur in construction, other things. The pickup in manufacturing was corroborated by financial data. We used market, which said U.S. Manufacturing Purchase Managers Index rose to a 4-month high in the final reading. They give a number of readings. This is market. Their analysis, and they tend to give a preliminary reading and a pre-reading, and this was the final July reading. The improvement in employment dovetailed with a separate report from the Labor Department showing initial claims for state unemployment benefits dropped 19,000, seasonally adjusted 326,000 last week, the lowest since January of 2008. Now, something to say about that, if you go back to 2008, 2007, we still had an abnormal amount of redundancies out there. 325,000 is quite a few, and these are just initial claims. Now, it is not the whole ballpark. While claims are usually volatile, of course, in July due to auto plants, but the auto plants in the U.S. are less. Had expected new filings. This is economists to 345,000. Well, that's not the modern thinking anymore, because since the Great Depression, we call it Depression, and prior to it, the automobile industry, specifically in Detroit, which is in bankruptcy now, had been less volatile because of the closing of plants by GM, Ford, the whole lot. So in other words, the excess fat, so to speak, had been rooted out or had been into planned obsolescence for quite a while there. The 4-week moving average for new claims, when ironed out week to week, volatility fell 4,500 to 341,000. That's really not that significant. This suggests the labor market is still expanding. There's no sign of it is slowing. It might actually be picking up a bit. This is from David Sloan. He's senior economist at Forecast in New York. Automobile, we talked about that. Traditionally closed their plants for retooling in July. A little different situation now. But they have now either shortened the shutdown period or foregone the closing. Well, part of it is the new modernization, and of course the workforces are not what they once were. Last week's claim data had no bearing on the Friday employment report for July, as it falls outside of the survey period. The government expected to report, and we'll have that incidentally on this week in economics. 180,000. That's the expectation. That was last month after rising 195,000 in June. That's expected, 184,000. Jobless rate is seeing ticking down a tenth. I think it's at 7.6 now, 7.5. However, there's a risk payrolls could surprise on the upside after a report Wednesday showed private employers maintain a higher pace of hiring in in July. Job gains in second quarter averaged roughly 196,300 per month. Need to be up about 250,000 to start to really pull out here. Number of reporters, Challenger and Gray and Christmas said planned layoffs at U.S. firms fell 4.2% in July. And a lot of this has happened because, as we suggested earlier, many of the sectors had already made layoffs through mergers, and an example of that would be HP's ongoing redundancy or layoff strategy. IBM has made some adjustments, and various other sectors, they have made these adjustments over the last, we'll say, 5 years, and they continue on. Manufacturing robust could get a boost. Robust demand for trucks start to strengthen the housing market. That's from GM, Ford, and Chrysler Group. Incidentally, there are some machinations with Chrysler. The Fiat Group is wanting to take more and more control there. The Fed, of course, had their policy meeting. I'll read that statement in the minute from the Fed. This is the 85 billion purchases. The next meeting, economists are silent on the issue. Was aimed at keeping the markets and interest rates tempered down. Well, we'll just have to read the statement here. It's a little bit different. There's significant upward revision in May and April left an overwhelming positive picture for the second quarter, Q2. Out there, this is from Peter Newland. He's a senior economist at Barclays in New York. Construction spending dropped 0.6% to an annual rate of $854 billion. That's from the Department of Commerce. So there's a lot of different numbers coming out here, and there will be more numbers going on. The Fed balance sheet, we'll look at it. We usually like to shrunk for the first time in 9 weeks. The Federal Reserve balance sheet shrunk first time in 9 weeks. We reduce holdings in mortgage-backed securities. The balance sheet liabilities, which are a broad gauge of its lending to financial systems, stood at 300.52 trillion in July, the end of July, compared with 3.532 trillion on the 24th. Fed's ownership of mortgage bonds guaranteed by Freddie and Fannie and the Government National Mortgage Association. Granny Mae dropped to 1.247 trillion from 1.261 trillion the previous week, so it is dropping. The Fed holdings of treasuries, however, rose to 1.92 trillion as of Wednesday from 1.97 trillion the previous week. Fed's holding of debt issued by Fannie Mae, Freddie Mac, and the Federal Home Loan Bank System totaled 66.52 billion on change there. The overnight loan to credit-worthy banks via the discount rate averaged 11 million a day during the week, compared with 10 million the previous week. So the Fed has been lending more money. Basically, there's what we are seeing. A little more on the market report here on manufacturing. Grew in July. We talked about that. And their numbers there. That with them, this is from Chris Williamson. Needlessly, the rate of manufacturing growth remains weaker than at the start of the year, no doubt about that. In particular, employment is generally rising at a disappointingly weak pace. He added that the rise in new export orders may reflect payback from declines seen over the prior 2 months. Well, a little bit different here. Usually in the summer months we see a little different effect here. The central bank's policy setting committee gave no hint on Wednesday of immediate pullback in their purchasing. Government data, this is all on Wednesday also. The economy grew at 1.7% rate in Q2, beating the 1% forecast in recent Reuters poll. Well, these polls have been off a bit, and that could actually be revised up closer to 2%. It's very difficult to say it at this particular point in time where it could end up. But the Challenger thing, let's get to it. This is from the Challenger Great Christmas Inc. people. We talked about the 4.2%. Employers announced 37,701 layoffs last month, down 4.2%. Since July, job cuts were up 2.3% from the same time a year ago. Now, we talked about some of this happening, some of it's structural. Let's see, 2013 so far, employers have announced 296,633 job losses, down from 319,946 that was seen the first 7 months of the year. At the current pace, layoffs for 2013 could be below the 2012 total of 523,319, which was the lowest since 1997. So you can see things have not really been rosy for a very, very long time, actually. The health sector saw the biggest layoff, cutting 6,843 workers, the largest monthly amount for the sector since November of 2009. Aerospace defense contractors came in second, 4,889 workers. Fewer than 1,000 of last month's layoffs were attributed to the sequester or austerity. Figures came a day ahead of the key job report. We talked about it prior to, and we'll just have more on that as we move along here. You can move back here a second and look at one other thing here. a little bit of some of the we thought we were. I guess we weren't. Some numbers here we wanted to go. Here they are. The key rates, the 30-year fix today is at 4.39. A month ago it was at 4.40. The 15-year is at 3.44%. These are rates here. And the 30-year, well, we won't go into that, but the 30-year fixed jumbo is at 4.73. You can kind of see what's going on here. Take a quick look at savings. 1-year CD is at 0.70. Nothing is there. The 5-year CD is at 0.34%. You can see actually how low things have went. The CD market is going basically nowhere. So the action is in the stock market. We'll go to the international economy now and take a look at it, and then we'll come back. Well, no, actually we'll do the Fed statement here. Wait a minute, just a second here. We'll grab it. We'll get the Affordable Care Act later here. And just 1 second here. This is a release via the Philadelphia Fed dated on the 31st day of July. And I'll just read it. Information received since the Fed Open Market Committee met in June suggests economic activity expanded at a modest pace during the first half of the year. Labor conditions have showed further improvement in recent months on balance, but unemployment rate remains elevated. Household spending and business fixed investment advanced, and the housing sector has been strengthening. The mortgage rates have risen somewhat, and fiscal policies restraining economic growth, partly reflected in transitory influences. Inflation has been running below the committee's long-run objective, but long-term inflation expectations have remained stable. Consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. The committee expects that, with appropriate policy accommodations, economic growth will pick up from its recent pace, and unemployment rate will gradually decline towards levels the committee judged consistent with a dual mandate. The committee sees a downside risk to the outlook for the economy, and the labor market has diminished since the fall. The committee recognizes that inflation persistently below its 2% objective could pose a risk to economic performance, but anticipates inflation will move back towards its objective over the medium term. To support strong economic recovery and to help ensure that inflation over time is at a rate more consistent with its dual mandate, the committee decided to continue purchasing additional mortgage-backed securities at a pace of $40 billion per month, and long-term Treasury securities at $45 billion per month. The committee is maintaining its existing policy of reinvesting principals from the holding of the agency's debt and mortgage-backed securities in agency-backed securities, and rolling over mature Treasury securities at auctions. Taken together, these actions should maintain downward pressure on long-term interest rates and support mortgage market and help to make broader financial conditions more accommodative. The committee will closely monitor incoming information on economic and financial developments in the coming months. The committee will continue its purchase of Treasury and agency-backed securities and employ other tools as appropriate until the outlook for the labor market has improved substantially in a context of price stability. The committee is prepared to increase reduce the pace of its purchases to maintain appropriate policy accommodation as the outlook for the labor market or inflation changes. In determining the size, pace, and composition of its asset purchases, the committee will continue to take appropriate account of the likely effective costs of such purchases, as well as the extent of progress towards its economic objectives. To support continual progress towards maximum employment and price stability, the committee today reaffirms its view that a highly accommodative stance of monetary policy remain appropriate for the considerable time after asset purchase program ends and the recovery strengthens. In particular, the committee decided to keep the target range for the federal fund rate at 0 to 1.4%, currently anticipating that this exceptionally low rate for the funds rate will be appropriate at least as long as employment remains above 6.5%. Inflation between 1 and 2 years ahead of its projection to be more than half a percentage point above the committee's target of 2%. And long-term inflation expectations continue to be well anchored. In determining how long to maintain a highly accommodative stance of monetary policy, the committee will also consider information including additional measures of labor market conditions, indications of inflation pressure, and inflation expectations, and reading of financial developments. When the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with long-run goals of maximum employment and inflation of 2%. Voting on the monetary policy action were Dr. Bernanke, Dudley, Vice Chairman Bullard, Elizabeth Duke, Charles Evans, Jerome Powell, Susan Broome Rankin, and several more, Janet Yellen. Voting against it were Esther George, who was concerned that continual high levels of monetary accommodation increase the risk of further economic and financial imbalance over time that could cause an increase in long-term expectations. So this was their statement that they put out, and judge it for yourself as to how those conclusions will, of course, conclude. Now on to the international situation here, as we like to do. The Goldman $1 billion fraud is liable, and $1 billion the trader liability in the Goldman. Jury found a former Goldman Sachs trader, Fabrice Terre, liable for fraud in complex mortgage that cost the investor, $1 billion. So thus, Goldman is on the spotlight once again. Australia unveiled a levy on some bank deposits for a stability fund aimed at safeguarding against bank collapse. So similar to the FDIC here, but has unveiled a levy on some bank deposits. Money, it says, will go towards a fund, a safeguard against bank collapse. Deposits of $250,000 will have to pay a levy of 0.05% from January 2016. It will impose on banks, not account holders. The banks have warned costs may be passed on, obviously, to the consumer. Updated financial statement from the Treasurer, Chris Bowen. The government says it expects a deficit of 30 billion Australian, and that is $26 billion and 17.8 billion pounds in the current fiscal year, compared with 18 billion there. I guess the only time the Australians actually make the news, as one would say. Exxon's profits lowest since 2010. Exxon said weak refining margins and volumes associated with planned refinery turnaround maintenance. They do this every summer, basically, in most places. It earned, $6.9 billion. That's in Q2, down from $15.9 billion in 2012. Shares next on Mobile fell $1.65, or 2% to $92.08. Exxon had boosted second quarter last year by the sale of a Japanese lubricants division. Take away those gains, net income fell this year by 19%. So ExxonMobil is not in the driver's seat as it once was. Exxon said production of oil and gas fell, 1.9% in the quarter, making it the ninth straight quarter production has fallen for ExxonMobil. And the TransCanada here, we might as well get them. Oil firm TransCanada, they are the ones that behind the Keystone Pipeline in the U.S., unveiled a plan to build a pipeline from Western Canada to the country's Atlantic coast. As plans, of course, on Keystone is stalled. The 12 billion Canadian dollars, that is 11.6 billion dollars, and 8 billion pounds. That's billion dollars. Energy East Line would carry 1.1 million barrels of oil per day. That would replace oil imported to the east of Canada with leftover supplies to be exported across the Atlantic. While the company's Keystone pipeline, that's from Alberta to Texas, faces some problems, no doubt about that. This is a historic opportunity to connect the oil sources of the Western Canada with the consumers of Eastern Canada, Montreal, those are Quebec, and creating jobs, etc. Well, we'll see how many they create. He projected the supply refineries in Eastern Canada would currently process 750,000 barrels of imported foreign oil each day. As much as 82% of oil refined in Canada's Atlantic region and 92% of the oil piped to refiners in the province of Quebec is imported from other countries, including Nigeria, Angola, the Mideast. That's according to the Canadian government. The Energy East pipeline would link roughly 3,000 kilometers. That's 108 1,864 miles. Have already built natural gas pipelines. The company's projected its piping to Quebec by 2017, to New Brunswick by 2018. The Keystone pipeline, $7 billion proposal that has got problems there in the U.S. Pipelines are a private drive to improve infrastructure for oil industry in Canada. The country with the third largest reserves behind Saudi Arabia and Venezuela. TransCanada's call for more pipelines to Canada oil to North American markets. Well, we'll see. Analysts forecast Canadian oil production will rise to 3.7 billion barrels per day in 2025 from its current 1.5 million barrels per day. So that would be a substantial progress. So let's continue on our international news. Royal Dutch Shell, their profits also, as one would say, slipped. Manufacturing in China. The official Purchasing Manager Index, which surveys the biggest firms, rose to 50.3 in July from 50.1. However, the HSBC PMI, which tracks smaller firms, fell to 46.7% from 48.2%. The PMI is a key indicator of manufacturing activity. A reading below 50, you got problems. This is the third month in a row that the HSBMC reading has been at a lower level. Figures released earlier this month show the world's second biggest economy grew at an amortized rate of 7.5% in April to June quarter, down from 7.7% the previous 3 months. That's not bad for China. Chinese manufacturing, of course, and export sector have been key drivers. They want to move to more domestic accommodation. To make matters difficult, labor costs in China have been rising, resulting in some companies to move towards Bangladesh, Cambodia. In other words, these companies move around the globe, who has what, when, and where. China has unveiled fresh measures aimed at boosting growth. Last month it said it would suspend their VAC, as value-added tax, and turnover tax for small businesses with monthly sales of less than 20,000 yuan. That'll start yesterday, August the 1st. So China is moving right along, and also unveiled plans to complete the open Chinese railroad construction market to ensure the country can develop the sector for long there. Well, the Chinese have made quantum leaps in their rail system there. They have an excellent rail system, and also an excellent system as far as their urban transportation. INEP says Greece must deliver reforms at a faster pace. On Monday, it backed the next payment of 1.7 billion euros, and that is what, 1.5 billion pounds, $2.3 billion. In its fourth quarter review, it said Greece must deliver more rapidly on reforms to unlock growth and create jobs. Well, some of that's not going to happen. Greece has granted a huge 110 billion euro loan. EU sources told the Reuters service there are various ways in which the gap for 2014 can be closed, either through member states providing new loans or possibly Greece returning to the markets to issue small short-term bonds. The Greek economy is in balance. Well, this happens in many of the industrial nations. The IMF said Wednesday, however, it continues to do so through recession and not productive, enhanced structural reform. Greece is in its 6-year recession and has seen a 25% drop in output since 2007, peaks and unemployment rate at officially at 26.9%. The IMF says the country has stabilized its economy, is on a course. One thing to remember about Greece, it's more of an internal economy except for tourism. A lot of farms, a lot of things done there. It's not a big manufacturing economy. IMF said Greece's debt would peak at around 176% of GNP in 2013, declining to 124 in 2020. Additional contingent relief measures of about 4% of GNP from Greece EU partners to be determined there. Debt stability concerns continue to remain a risk, no doubt about that. But in reality, the Greek debt is, as we'd say in the U.S., small potatoes, something the EU is forced to take care of. They have no alternative. Greece will continue on. Some reforms will be there, such as taxation. But we don't see at this juncture a lot of selling off of state-owned businesses. A lot of resistance to that. Let's do the numbers. The FTSE These are all Thursday numbers at 60.92. The DAC was at 190. 194.76. Okay, well, we'll go with that. In Zurich, in France, they were at 50.04. In Brussels at 54.73. In Madrid at 106.80. In Zurich at 10.26. In Moscow at 22.67. In Johannesburg at 16.55. In Bombay at 27.68. In Karachi, they were in the red at 220.91. Also in Lahore at 76.57. And in Colombo, in the negative 18.26. In Tehran, on Wednesday at 768. That was positive. In Sydney, they were also in positive territory at 48.90. The Nikkei, these are Friday, incidentally. We've switched a little bit here. Bombay was also Friday. The Nikkei at 22.40. The Hang Seng at 123.83. And in Shanghai, on Thursday, they were at 35.27. On Thursday, the Dow was at 128.48. The Nasdaq at 49.37, and the Merc, the commodities market out in the Midwest city of Chicago, at 21.14. In San Pablo, also on Thursday, 906.29. And in Mexico, they were at 1,025.88. Good day for most of the markets. We'll take a quick look at the commodities as we go out. Brent crude futures at 109.40. That was a change of $1.70. The spot is at 108.94 at $2.98. The rise there. West Texas crude was up $2.75. T-Boone Pickin is happy. We're not, at 107.89. Gold was up $1.70 as to buy gold at $113.27.70. Interesting. And let's see, we can get corn futures down $11.50. That's a good sign. Soybeans down $16.25. Wheat futures down $6.25. Cocoa was up $3. That's good for West African nations. And as they say, so we go. Have a good weekend there. We'll return on Saturday night, Sunday morning with on Blog Talk with the This Week in Economics. This is Numbers Man out on the 2nd day of August 2013. Good day.